The question of how best to invest in personal finance has puzzled individuals across generations. Yet the answer lies not in complexity, but in understanding fundamental principles that have stood the test of time. Before considering any investment vehicle, one must first establish a solid financial foundation. This begins with creating an emergency fund containing 3 to 6 months of living expenses, positioned in an accessible savings account. Only after securing this safety net should one venture into the realm of investments. The most effective investment strategy embraces diversification as its cornerstone. Rather than concentrating resources in a single asset class, successful investors distribute their capital across multiple vehicles. Index funds and exchange-traded funds represent particularly prudent choices for those seeking broad market exposure with minimal fees. These instruments provide instant diversification by tracking entire market segments, reducing the risk associated with individual stock selection. Retirement accounts deserve particular attention in any comprehensive investment strategy. Tax advantage vehicles such as employer-sponsored retirement plans and individual retirement accounts offer significant benefits that compound over time. Contributing enough to capture any available employer matching represents an immediate return on investment that should never be overlooked. The power of compound interest cannot be overstated. Beginning early, even with modest contributions, allows time to work in one's favor. A consistent investment approach, maintained through market fluctuations, historically outperforms attempts to time the market. Risk tolerance and investment horizon must guide asset allocation decisions. Younger investors can typically afford greater exposure to equities, while those approaching retirement should gradually shift toward more conservative investments. The best investment strategy ultimately combines patience, discipline, and continuous education. Regular portfolio reviews, periodic rebalancing, and staying informed about economic trends contribute to long-term success. Remember that investing represents a marathon rather than a sprint, where steady progress and informed decisions yield the most substantial rewards over time.